Hi, this is Randy Finney with the right side of the chart, and this is a closing market wrap for the week ending Friday, November 15th, 2019. What we'll do is we'll start out with just a quick update on the technicals on the stock market, meaning look at the charts, and then I'll take a look at a couple fundamental things that I want to point out. All right, this is the NQ 60-minute chart, same chart I've been highlighting now for quite a while, and with this same trend line. It comes off the October 3rd, I believe it's October 3rd lows, well-defined trend line. And in yesterday's video, or let's back up. For last couple weeks here, I've said we really need to take out. This has been sort of my magic number, 8,200, saying we need to take out 8,200 to trigger the next pullback. And these are my downside targets, still about 80, 40, 80, 50-ish. That's a support zone there. And quite likely, and I'm leaning that way now, more and more that way, towards about at least 79, 78. And again, that's what I call my preferred swing targets, and meaning if we get there, maybe I'll extend those. If we, if we don't get there, if we start to, let's say we only get down to this 8122 target, well, something in the charts convinced me. That's maybe where, if we get a, first of all, if we get a sell signal, that's where I'll cover. Just to reiterate, if you're not a member of the site, on the YouTube channel or on rightsideofthechart.com, you can come in. Public, free content is basically general market analysis, stock market coverage. It is a small part of what we do. Sometimes I'll actively trade the markets when trading's conducive, and that's when, especially with things like NQ, the Nasdaq 100 futures, or QQQ, when the volatility is up, when the VIX is high. But day trading opportunities are very they're almost non-existent right now in the indexes. We've been killing it with natural gas lately. Another couple trades pointed out today in the trading room in the last couple days, and all the swing trades on the site that we've had lately, both official and unofficial, almost exclusively have been longs for weeks now. Generic drug makers, specialty drugs, help those healthcare stocks. Things, all types of things, commodities, agriculture commodities, even Bitcoin trade, stuff like that. So that's where the opportunities lie, and that also kind of just gives a little takeaway for those trying to actively trade the market. Here's some statistics that the Wall Street Journal just put out today. The S&P 500 through yesterday, through Thursday, just had its, it hadn't moved up or down more than 0.5% for 9 consecutive trading days through yesterday. So that's 9 consecutive trading days through Thursday that we had less than 1.5% move up or down in the S&P 500. And guess what? That was the longest streak since October 2018. So if we go to S&P 500, I'll look at SPY. This is it right here, just before. And it doesn't mean it's going to happen again, but I do want to point out that was the last time that we had a consecutive streak of 9 consecutive, or streak that long, 9 consecutive trading days of less than 0.5% moves. So what is the takeaway from that? Well, one of the takeaways is, remember, I've been highlighting the VIX recently. I have a support zone here on my VIX chart that right here, these two lines, and each and every of the significant corrections that we've had, including technically a bear market, a 20+% drop at that followed that October reading right there in October 18, they all started from this level when the VIX fell down to there. Sometimes you had the one and done tag, like those two, and you had a stock correction in the stock market, and sometimes you stayed persistently low for a while. But the takeaway is a couple things. Number one, day trading ops are almost non-existent, so I've cut back on or at least on the index day trade setups. I posted a day trade op. It turned out to be a day trade on natural gas in the trading room again today after posting quite a few. Popped resistance. We're good for a quick 1.5% gain, and then hit the target and get out. But so that's something to note, that day trading ops will vanish at that point in the indexes. But again, the takeaway, as I showed you there, is don't fall asleep at the wheel, because it is after those periods of extreme low volatility that typically follow the big moves. And remember, volatility, when the market corrects, it tends to fall a lot faster than it rises, and that's one reason the VIX hits low levels during a rally everybody comes complacent, seems like there's no risk in the market because they're going up, 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 and then come the big swift drops that it's very common in just a few days, like right here. It is not unusual, in fact it's common, to wipe out weeks and even months of gains in a couple days. So the takeaway is, look, there's the music playing right now. I use that analogy, a game of musical chairs. The momentum's up, a lot of sectors are moving, just about everything, and that's why the majority of the individual stocks and sectors we've been trading have been longs lately. But don't fall asleep at the wheel, and don't be the last one standing when the music stops when you're playing a game of musical chairs, meaning don't be the bag holder. Be on the lookout, and that's why I go over these levels in advance. So just to get back to the technicals here, so here's the trend lines on SPY, or the uptrend line. Again, I covered that on all the indexes recently. We have the October 3rd lows, broke down and back tested today. I want to add something to these trend lines, but I'm just going to update. So there it is, nothing but a back test so far. And if you recall in yesterday's analysis, let's go back to the futures, I did say that we were right here, and I've been saying for a couple of weeks we've got to break 8,200 to really get some, in my opinion, to get some traction going to the downside. And when it breaks, I think it'll be relatively fast. I think you'll see volatility expand. I think you'll see drops of over 1%, and several of those at that point. And so you'll again could wipe out the last several weeks of gains in just a few days there. Who knows, maybe a day or two. But we need that sell signal. But yesterday I said, until then, if we were to rally today, which we did, we closed up. Again, nothing big, but I said as long as it didn't exceed, take back this trend line, it won't change anything from a technical perspective, and that's so far that's the case. So we were there yesterday, we had back tested, we moved up, we just came in, and all we did is back test this trend line from below again at a higher level, and simply extended the negative divergences. So from a technical perspective, again, especially on a day like this, nothing's changed, and so therefore nothing's changed. My outlook, we still need to reverse, ideally impulsively, and that would start to give you a little more confidence that we might get a break at 8,200, and then once 8,200 breaks, again we'll see if we zigzag down here to those price targets. All right, back to the charts, and then once I wrap up here with the technicals, we'll look at a couple fundamental issues and then finish the video. So there it is, SPY breakdown, back test of the trend line. QQQ, this is the daily chart breakdown, back test today, which just extends also the divergence on the daily chart. Here's the daily time frame. When you look at the indicators down below, here's your PPO. I'm zooming it out. We never got, see, there's still a few more things needed too for to give us at least some decent sell signals. We still need a bearish crossover on the PPO. Look like it's close, but it didn't cross today, so that's still pending. And I want that because that would then confirm this potential. This is what I call potential but unconfirmed divergence. I need to see a bearish cross in the PPO, which then effectively puts in a lower high, which is the definition of negative divergence. Prices making higher highs and the indicators making lower highs. But when you have a momentum indicator that is headed higher, if it continues higher, it can eventually take out the divergence. That's why I call it potential and not confirmed. Just something, I kind of my term. All right, so we'll look for that. So there's a couple things. We need QQQ to get that bearish crossover. We need to see a rejection off the back test of the trend line, and on the QQQ 60-minute chart, as I've been saying, I want to see 199.80 go. That's comparable to that 8,200 level on NQ. So 60-minute divergence still very much intact right there, the bearish divergence, just as it was back here at this divergent high, small high, divergent high, small correction. Back there you can see all the divergent highs and all the corrections in recent months. MDY mid-cap ETF, same story, breakdown recently, back test the trend line from below, or near back test today, and the same thing on the small caps. So not even a back test yet, just a breakdown so far, and still below trend. So we're below trend there, but one more thing I wanted to add is today I went through the sectors. There are 11 sectors in the S&P 500. No need to go through them all, but the big ones which have the biggest impact on the market, XLK by far is the most important. That's about nearly a quarter, over a fifth of the S&P 500 is the returns are attributed solely to this one sector, technology, and about half, or even I believe over half of the returns in the Nasdaq 100. So I wanted to point out you may want to replicate those trend lines. If you want to spend a resilient trend, give it the benefit of the doubt. If you're waiting for the next swing short, objective short entry, there's the trend line off the October 3rd lows. We have not taken it out in XLK. So it's kind of odd. We took it out in all the indexes, as I showed you, the same trend line, and there it is in XLK, yet to go. Same thing with XLV. XLV is healthcare. As I said, that's where the majority of the long trade ideas I've shared on the site recently have been in the healthcare sector, generic and specialty drug stocks. But that one's still above trend as well. So you need to watch these financials. There's another one. This is the third largest weighted index, still above trend. Yeah, you could. Yeah, I think that's the safe trend line right there. I was going to tighten it up a little. So let's watch these guys. XLC, the fourth largest. These are all, I'm going in order of weighting, and there's XLC. So if you want to give it the benefit of the doubt, replicate these trend lines. This one's a little bit different in XLY, and you want to see those go as well. And when you go, I think that's it is what I would call a high probability sell signal, as well as those support levels, those price supports on NQ and QQQ. All right, so that's, I believe, it for the technicals. Let me just check. Yes, that's it. So now we'll roll into a quick look at the fundamentals, and we'll wrap this up. All right, so if you're not familiar, technical analysis is using charts, things such as charts, volume, and to try to determine where security is most likely headed. Whereas fundamental analysis, that's kicking the tires, looking under the hood, looking at balance sheets on individual companies, earnings reports, things such as that. Or in the case of macro fundamentals, economic fundamentals, the economy, you look at this. This is the economic calendar. So today we had two market movement reports. You can access this on the right side of the chart under resources. That brings it into the support center, resources on the main menu, and then there's under tools of the trade, there's a link to this economic calendar. And the red dots are the potential market moving reports. So you had two today. You had retail sales out at 8:30 a.m. and you had industrial production. So really what's gone on, if you're not aware, in the last couple of weeks there's been a very, very stark and pronounced turnaround in sentiment in the market, because we've had earnings season came out good, and we can't knock that, and most importantly, the employment situation remains very low. Unemployment rate is low. The job market's still strong, and make no mistake about it, I'm going to show you a couple things here, but the consumer spending is by far the most important thing to track, because the consumer spending accounts for about 70% or so of GDP, and GDP, that's what they measure the economy by. Two consecutive quarters of contraction in GDP is the definition of a recession, so we don't have that right now, but you want to watch it. So anyways, when retail sales are good, it means consumer spending. Now they came in okay. They came in at a month-over-month increase of 0.3% versus an expectations of 0.2%. So slightly above where they were expected to come in at, nothing huge, and it just shows the consumer is still spending for now. These reports are a little dated, keep that in mind. The other report was industrial production, and it's funny because I cited the article that they put out, the Wall Street Journal published after the close today, citing the low volume statistics, and they were making the case why the market's doing so well, citing good earnings recently. Today's retail sales report, somehow they completely missed industrial production, but let's talk about that, because that's one thing I've been watching. It's maybe looking at glass half full stuff, but these are things that stand out. And industrial production it fell 1.1% in October. That's a year over year. That's the biggest annual decrease in industrial output in 3 years. A 1.1 year over year drop. And that to me is very concerning, and it seems the market just shrugged that off. Let's take a look at a chart here and show you. Let's see if I can pull that up. Okay, here it is. Now I took this chart, I annotated it a little bit. It comes off tradingeconomics.com, and I'm kind of blown it up here a little. It was a smaller chart, so it might be a little blurry on the video, but what I noted here, okay, the blue line Plain and simple. That's industrial production. We're going back a couple years here. And let me grab a line tool here, arrow tool. So there's industrial production here in blue. You can see right here, this was back in about 2014 leading into 2016, and you can see it here. We're on almost an identical path. We haven't seen anything like this. The closest blip we had was after a tremendous surge coming off the Great Recession. Remember, this was when you come off the bottom, there's nothing but up, so you see these crazy. So really, once this the bull market kind of and the economy has kind of gotten on track and things got underway, this is your industrial production, up down, but you saw this drop off there. And again, so as I mentioned, this drop we had, the last time we've seen anything like this was 3 years ago. And let's take a look. If you're not familiar, if you hadn't traded long enough or investing or wasn't your thing back then, let's just let me remind you what happened back then in the markets. So that was early 2014, or no, about not early 2014. That was about late 2014 right there. Okay, here's QQQ. Here's 2014 back here, and we're gonna zoom in a little bit and take a look at that time period. So that started to slow about 2014. There was a blip here, and that continued up until that point. Let's go back to that image there, right there. So we started dropping in about 2015 here. There's the peak there, late 2014, but about 2015 we really started falling like we are here. And it took a while, and if we fell, industrial production fell right into about the end of 2015 there. And so if you look at what happened back then, here we go. We had first this drop here. That was you can see the pop-up box to the left on the very bottom in red, just above the word annualized. You see the total drop. That was a 10% drop there. So we had quite a few shots across the bow, and then leading up to, this is again, just like now, while industrial production had already turned, already had been falling in a significant trend, but the market was doing the same thing, ignoring what was going on, and that's a big part of our economy right there, by the way, industrial production. From there we had, and this is just a period of about 1 month, you can see in the pop-up box, 26% drop in QQQ, and yes, that was the actual drop. Now the Nasdaq 100, because QQQ is an ETF, QQQ I recall, and several individual ETFs had mini crashes, but the index itself did drop. Here's the NDX. So even if you back out the little excess, because they overshot being ETFs, there were just a collapse in the bids, I call it, where there's no buyers left, and that's what happens when a one-sided market. There's too much bullish sentiment. Everybody thinks it's going to continue to go up, but they're ignoring deterioration in economic fundamentals. And this drop there, even in the index itself, was about a 20% drop. So, technically, a bear market back in 2015. And again, all that time, that's where we had the industrial production started to fall, and it reached a point where the market ignored it. It didn't matter because price action was bullish, and until it all of a sudden did matter. And so again, just to show you, in a span of exactly 1.1 months, 11 trading sessions, that is, it shows you 11 bars, we wiped out, the Nasdaq 100 wiped out in 1.2 years, over 1 year of gains, wiped out in 11 trading sessions. And that's not unusual. We did it, almost the same kind of drop right there as well. So guys, these are the things I look at, and again, I can make this case. That's what I do. I point out things that I see that are red flags. Market continues to grind, and that's usually the case. When market wants to go up and everybody's bullish, they keep buying, but you need to watch that. Now, maybe industrial, maybe it's a blip. Maybe it's, well, you can't call it an aberration. You certainly can't. This is a trend. This is a steep and concerning trend that, again, for some reason, the market doesn't seem to recognize, although it does. And we're going to roll into one more fundamental thing here, and then we'll wrap this up. So again, stock market's at new all-time highs, ignoring the fact, just as it was roaring back here up until, and it doesn't look like much. These are that's that 25% drop back here, and followed by the other 15 or so percent drop. Again, the market ignored it until it decided not to ignore it anymore. And so just food for thought, and if nothing else, a takeaway: if you're catching this, where you're long this rally, you're waiting for sell signals, that's fine. And this stuff may reverse. This may all of a sudden you may see a tick up in industrial production, and then everything's good. And it turned out to be really not a big deal. However, don't underestimate how far and fast stocks can fall. That would be the point I would try to impress upon you if you are long, and just use stops, and just be careful. Be asset allocation, diversification, everything I preached recently. Okay, and we're going to take a look at one more thing, and just to jump back to that big. And remember, this wasn't just a series of two corrections back in 2015 and 2016. By the way, this was what is called a deer market. A deer market is neither a bull or bear market. It's when stocks go sideways for a while. So if you look at this, from this point right here, or from this point, you can see this was a nearly 2-year sideways market where stocks effectively went nowhere from this point right here. Back to here, they were back here, and then we traded in a very large sideways range. Now that range eventually broke to the upside, and we took off from there, but I just want to point out. So let's just look at this real quick where that happened. Okay, the big drop, the first one came right there around the mid to late July 2015. Then there was a relief rally. Market actually broke out to new highs. Everybody cheered it, and that was about let's see, several months later, about 3-4 months later, actually right here. Yeah, about 4.5 months later, market made a new high, a marginal new high, followed by yet another very sharp and powerful drop there of almost 20%. And that one was in late December 2015. So what we're going to look at now, in the last chart of the day, is, or I should say, are credit spreads. Credit spreads, if you recall, just did a analysis using JNK, the junk bond ETF, against the S&P 500, showing you a very, very stark divergence, unlike anything we've seen the last couple of years, where the stock market's, I'm not going to use the word rip because it's certainly not ripping up, but it's had a steady trend up to new highs recently, a straight and steady, climb up, and whereas junk bonds have gone the other way. Now this is another way to track, junk bonds, or what we call credit spreads. This is the ICE, Bank of America, Merrill Lynch, U.S. High Yield, Triple C. Those are the ratings on junk bonds. These Triple C or lower option adjusted spreads. So these are what we call credit spreads, spreads between treasury bonds and these junk bonds. And so what I've done on this chart, I've had this saved for years, is I've inverted the Nasdaq Composite. Yeah, it's the tech-heavy Nasdaq. So really what you're looking at, the blue line, when it's going down, is this is the Nasdaq, but in reverse. So it's showing you rallies is downtrends, and here's your corrections. So you had a correction here. That was 2014. You can go back to this chart. And remember, this was a first shot across the bow in 2014, and that's when industrial production had started to turn. Market it had a nice, over a 10% correction right there, but then it resumed. And remember, the big tops came in 2015. But I want to show you something that it's really this what I was showing you with junk bonds. So by inverting these, it helps visualize. If you're not very visually oriented, you can see the inverse correlation easier, because now it's a positive correlation. In other words, credit spreads will drop when everything's healthy under the hood in the stock market, and the stock market's climbing, and that's what you're seeing here. So forget the annoying pop-up box, but let's just do it like this. Okay, here we go. So you can see credit spreads dropping along with the stock market rallying. Remember, we flipped it upside down. What I look for here are divergences. So when all of a sudden you start to see things go the other way, at this point credit spreads started to rise. While yet the stock market, it did have a little correction after that happened, because this is what smart money, this is what institutional investors look at. When all of a sudden you see credit spreads rising while the stock market's still rallying, that is a red flag. And so it happened. You had a correction in the stock market there, the one I just showed you in 2014. And then what happened? Stock market shrugged it off, said, no big deal, we're going to new highs, and it kept rallying. Yet credit spreads continued to rise. And then finally, that continued. This is again the Nasdaq right here, peaked in 2015, like I told you, had that 24% or so drop, followed by another drop right there in late 2015. And all along, what happened? Credit spreads were rising. So what happened again? It's a period where the markets were shrugging off a warning sign that not a lot of people watch. A lot of institutional, professional investors, economists will watch that. And again, I'm just pointing out red flags. We need the sell signals. So we have a lot of ingredients for a correction that can catch the masses off guard. So what I'm zooming in now is to today and showing you the divergence. I showed it to you with junk bonds the other day. But again, here we go. So this is the Nasdaq Composite right here, breaking out to new highs recently, right? This has been the trend. We've had a couple corrections along the way, but the trend is up. Yet credit spreads, as you can see, are diverging. You can see a near perfect correlation before. I've talked about this. Don't look at the distance between these because they're priced on different scales. You want to look at, do they move in sync? And they move in perfect sync normally. When one goes up, the other goes down. Every time the stock market corrects, you should see a spike. You do see a spike in credit spreads. Right there, you had a correction. That was a big drop back last fall. And that one caught a lot of people off guard. Remember, we saw that correction coming. I then walked through day by day like we're doing now, waiting for the right sell signals, saying we need this and this and this to happen. Break up down in tech, break in QQQ. The day we got it, I said sell signals triggered. I had targets down very close. We slightly exceeded my downside targets, whereas everything I read, nobody knows why that happened because they didn't see a spike in credit spread. So I want to say that sometimes you don't get a warning in credit spreads, but it should certainly not be dismissed when you do get the warning, and that's what it's telling us here. Credit spreads have steadily been rising and diverging as the stock market is rallying to new highs, and that is plain and simply a red flag. Now, like I talked about with JNK and SPY, maybe this divergence abates, meaning credit spreads come back in. Maybe the market corrects and works off whatever's going on there, but there's something in the credit markets right now that are not confirming this breakout to new all-time highs. We're going to leave it here, and again, this stuff can happen. Maybe these divergences continue for another week, month, year. Maybe they never play out, but they are certainly, in my opinion, a red flag and something to watch. So like I said, unless we get sell signals in the market, I'll focus my trades elsewhere. Individual commodities, stocks, sectors with the most bullish or bearish charts, and then when the time is right for the markets, we'll jump in there for the next trade. I just don't see an objective long entry or reason to buy this market right now, so don't have to fight it, but certainly don't have to join it either. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.